Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, July 3rd. Early close today, 1 p.m. equities, 2 p.m. bonds. We're just after the equity close. Where do we sit? Where are we positioned in terms of equities here at Q2? Very interesting Q1 and Q2. Had to withstand a little bit of a battle, some damage, some drawdown in Q1 into early April of Q2. You know, the big tariff day was the first week of April, and we saw quite a bit of volatility. By late April, markets started to repair themselves, and then into May have priced in an awful lot of what had been in the headlines. We don't know how that's going to affect markets from here through the end of the year, Q3 and Q4, but let's take a quick look at where we sit at the end of Q2. This performance review gives an idea of how different equities, both international and US, performed through both Q2 and year to date. So the middle column is your second quarter return. The far right column is your year to date return. Probably would have been able to get pretty good odds at the end of Q1 that the Qs wouldn't be up over 15% year to date, as tough a Q1 as they had. So you had real power in demand. And you're starting to see some indications in both in the options market and in some sentiment indicators that we've gotten to an extreme. Remember, sentiment indicators rarely give you any direction and are one of the more over-analyzed indicators out there. Sentiment is helpful at extremes, at extreme fear and at extreme greed. And we are starting to tick on some of those greed numbers that we see in the options market. When that may take a bite out of the market, tough to say. Tech very strong this week. Bonds have a bid. Even commodities are hanging in there. You know, if we glance back at fixed income and commodities, you really have a straight positive return across all markets, all the way down to the US dollar, which is negative, and on the equity side, the Russell 2000, which has now gotten positive for the year, the first few days of July, but certainly has had headaches. That's nothing new. So where we're positioned, we're fully invested, or as close to being fully invested as you can, in our US core, our US ETF, our international, all had outstanding second quarters, both from a performance standpoint and against the benchmark. Our tactical is about as long as it can get. We're a little shy of being fully invested on the US side. We need to get some money reinvested from a sale we had this week, KBR, which has been really the primary laggard in an otherwise stellar security basket. So we got rid of that. That was a small position, a 3% position. Tough to chase technology here, tough to chase industrials here, tough to chase maybe financials here. They've worked well for us. Some of the news this week on the reduced regulation on the banks, them meeting some of their bogeys in terms of balance sheet and so forth. Banks have moved their dividends higher, raised their dividends, some significantly, and they bumped their buybacks. So you saw a nice bid to the JP Morgans of the world. But you're also seeing a bid on the mid-sized brokers. So our banks in our US ETF strategy are working well, and our brokers, our capital markets companies, are working very well in tactical trends. We did buy them and add to them in that nasty sell-off the end of first quarter into Q2. So what do we know? Q3 will be interesting. I am going to lean on the fact that volatility this year will be elevated at some point. VIX won't tell you that right now. Quiet as can be. This was a very tough week for bears. Almost all industries and sectors working. Again, New money coming into the firm, probably have to be a little bit cautious on just flicking a switch and buying a full portion, aligning fully to an equity market here. Would love to see a little pullback, which means I probably won't get it. Market tries to frustrate you on all fronts. We've got the Moose coming up next. I hope everyone enjoys their 4th of July.
Hi, it's John Musso. I'm the Chief Investment Officer at Cumberland Advisors. It is Thursday afternoon, about 2:45 on July 3rd. This is the Bond Report. We're talking to you from Narragansett, Rhode Island, where I spent part of the summer. Behind me is Judith Pond, which feeds into the Point Judith Harbor. It's a great spot up in Rhode Island. It's the smallest of the 50 states, but it is most beautiful. This week in bonds, yields higher. 10-year Treasury at a 434. That's up 7 basis points. Rest of the yield curve up 5 or 6. Why? The jobs report today. Jobs report surprised people, higher than expected. It was another week of contrasting numbers, right? You're expecting 103. It was 147,000 jobs. On the other hand, and when you dig deeper, most of those jobs were state and local government jobs. Maybe some of that was picking up some slack from the federal government. But in any way, private employment was much more subdued. And when you look at the ADP report, which does show private employment, and that came out yesterday, that's a much different number. They're expecting to see 98,000 jobs. And what did they get? They got a contraction of 33,000. So there's no question that there's a lot of push and pull in the employment market. A little hard to get a handle on things. We're going to dig a little deeper on this. Our base case is that the economy will continue to slow down. Of course, we got the big, beautiful bill passed today, just awaiting formal House approval. That will have, a number of ramifications. But as far as bonds go, one of the things that we looked at there was the extension, if you will, or addition of SALT, state and local government deductions. And that is for state income taxes and property taxes. And that's really benefiting the Northeast states. It went from 10,000 to 40,000, the cap on deductions. We think this helps those states from a fiscal standpoint because it means the migration of people out of the states to places like Florida or out of California to, say, Texas slows down. And particularly when you think about Florida slowing down, the migration of Florida is not the layup that it used to be. It used to be, boy, you could sell your house, put a lot of money in your pocket, get no state income tax in Florida, and have a lower cost of living. Well, the house flip is really almost gone, and the lower cost of living in Florida is not true anymore because of the higher fees for both HOA fees as well as insurance fees with all the storms. So what this means is that you'll probably see people hang out in those higher tax states for a while. That is good for income taxes, and it's good for sales tax collections. And we do think this probably has a political end to it, where the president ran much better in a lot of those higher tax states in certain congressional districts, 3, 4, 5, 6 points better back at the election. And I think he's looking to try to capitalize that on possibly midterm elections and winning some seats that they might not normally win. More to digest there. We will obviously be waiting to see what goes on. We think today's number will mean that Jay Powell and the Fed will probably take a pass on lowering short-term rates in July. That would mean the next time they would do it would be September. Remember, it was last September that they first started cutting rates, and they cut by 50 basis points. That did not have the effect on the long market of bonds that we thought. Yields went up then. We think if they cut this time, yields will go down. We think a lot of that last year was predicated on people looking at the election numbers and Donald Trump rising in the polls and some expectations of possibly higher inflation. In fact, inflation has come down since then, but that didn't stop the bond market from being hurt last fall. We hope everybody has a wonderful 4th of July, a safe 4th of July, and we'll talk to you next week.
Thanks, Moose. And if you're interested in a deeper dive into the markets during Q2 and year to date and how our strategies have performed during that time period. Our Q2 review will be released next week. See you then.